We at Online Trading Campus are on record for calling the Corona crash before it happened. On the 3rd of January 2020, our mentors held a special live trading event titled Trigger Warning: The Corona Crash. In this live trading class, we clearly stated that there is huge potential corrective risk in the stock markets, looking at all equity indices and stocks. The fundamental recession indicators we teach in our unique OTC stocks course all lined up and were signaling a recession to be just around the corner for months, including the dynamic yield curve, which inverted back in August 2019. Stay tuned until the end of this very quick video to watch the live trading footage as a recording to see our full analysis we did live with our students for yourself. Now you may be asking, how is it possible to time a market crash when Wall Street is selling you the idea that market timing is impossible? Well, if you were invested during this time, then you know why. So that Wall Street and big institutions can short against your open positions. We want to show you that in reality, it is possible to time recessions on a fundamental level, as there are clear, objective fundamental warning signs that we can look at and learn to apply to the markets. The fundamental indicators we will teach you in our stocks course timed all of the previous market crashes, including the .com crash and the housing crash, months in advance. And therefore, it is possible to sidestep these potentially bad years in the stock markets to protect your capital at all times. But we want to go a step further, because you can also make a lot of money really quickly if you know how to short stocks and indices. Here I want to show you some examples of our students copying our big short trade ideas. Here you can see that in February 2020, we advised to short Tesla from the $900 level with profit margin all the way down to $350. And from there, we would expect Tesla to continue rallying. In the comment section, you can see that our students copied this trade, including Mike and Milos. Here you can see that we also talked about a short on the equity indices, including the Nasdaq in February 2020. I quote, "Short below yesterday's low, target, open, let it run." On the next slide, you can see the post of one of our students from March 2020 asking for advice on his running big short positions on Tesla, Facebook and eBay. You can see the advice from us. I quote, "As a general note, why I'm telling Cervantes to take profit, he's up 1 to 12 risk to reward on 3 trades that anyway are highly correlated. And you don't let a 1 to 12 go back to break even. A 1 to 12 in the future should compensate at least 6 months of your salary, so you would never let this slip away. If he was short only one stock with 1 to 4, I would have suggested to leave at break even. Hope this makes sense." Therefore, you can see that our students, including Cervantes, were able to not only sidestep this market crash and protect his capital, but most importantly, also benefit from it by shorting the markets on the way down. Now it is time for you to see the analysis of our trigger warning we've done live with our students for yourself. This daily channel where price is just jamming up in a very tight range here. Not a lot of price discovery happening, just prices jamming up off of, the the global money supply manipulation by the central banks around the world. This is just, being pushed upwards, and we said last week, this is just all about the Fed maintaining control. And if we were ever to trade below that trend line, then we would have huge corrective risk. Looking at Actually, also actually, when we look at the SPY, we can look at that scenario on the daily, and here probably you see it even more, right? You see it even more. That very tight channel here, price is just jamming up, and you can also look in in the past of what's actually happening if you get asset prices just jamming up, breaking out, and then all of a sudden you have a huge downside risk, because everything that's happened here is not really price discovery, right? That's not really demand. This is more like, I don't even know what I would call it, but more like filled orders here. All the orders that wanted to be filled are already filled. You don't have a lot of unfilled orders in this area. Therefore, price would ultimately go lower, looking for fresh unfilled orders. Make this red, and let's make this maybe transparency 60. I'm only going until here, right? I'm not gonna go all the way down here. So if that's gonna be our first corrective downside risk, then we've got a huge downside risk here all the way up until this breakout area, which then is also in line, with our monthly demand down here. Because we are now broken out, this can now cause a lot of volatility. It looks like the Fed has lost control here. Why have they lost control? We can and there we go into the trigger warning. What I wanted to talk about. So trigger warning, the coronavirus that's been spreading recently, and that's been going on in the news, and everyone's kind of talking about it. And actually, if you go back in history and you look at these pandemics and what they actually do to the markets, for example, in 2002 when we had SARS, it always depends on the overall context. So the news now are going to say, coronavirus is infecting the entire global economy and that's why prices are falling. No. Okay, that's not, just to be clear here, that's not what's happening. What's happening is that asset prices are extremely overbought. Extra asset prices are extended. They are rising way above their underlying economic basis. Okay, that's a definition of an asset bubble. And on top, central banks around the world are approaching their limits on how much how much ammo they have to intervene in the financial markets. And that's something we touched on in 2019 a lot, where we said, look, interest rates can actually be seen as ammo by central banks, by which they use to manipulate global economy. Either they lower interest rates, by which they will help the economy go up, or they increase interest rates, by which they would then actually tighten money supply. And now we've been in a time frame where we're talking about zero interest rates, negative interest rates, which negative actually has historically never been seen before. And all of the central banks around the world have more or less shot all their ammo. There's not a lot of central banks left that still have a lot of ammo. I mean, the US now have a couple of basis point left. But if you also look back in history and you take an average of what it took in history to kind of absorb a big global recession, is you usually took 5% on average to kind of fight against a global recession. Okay, what do they have left really? 1.5%, 2%. Congratulations, right? We would be talking about a a negative 3% interest rates, we all probably know what would happen to the bank sector if that then happened in turn. But anyways, what's happening here is let's be clear, we were in this channel and prices got overbought, and we got the rejection of our monthly trend line, right? Monthly trend line, monthly reversal, rejection, and the fact, that also I talked about this last week, the foot soldiers, like looking at the Russell, they're not, they've approached this all-time high area and, these weekly supply areas, and all that has done is they're now right back in this range where they were before, and if they go lower, if this is a double top kind of scenario, then this is gonna be extremely ugly. You have Nikkei extremely weak, you have the German DAX extremely weak, you have Dow Jones weak, and there's gonna be a lot of shorts and there's gonna be a lot of buyers trapped in this market, and we could really see 5 to 10% risk in the global economy. And the question then at that point would remain, well, are the buyers, and is the Fed going to further intervene, and then is this going to push the buyers back in this market, and are we pushing back up? This kind of all depends then on how this market will progress over time. But for now, what we can definitely say is, just looking at this chart and looking at the bigger picture context, and not just looking at S&P 500, but looking at the Russell, which is extremely weak, knowing that the Nikkei, the German DAX are extremely weak. They've both made double tops. Understanding that the Dow Jones is weak, understanding that the global economy is weak, understanding we're coming off of this bigger picture trend line up here. That's our bigger picture corrective risk, if you want so. Okay, that's our bigger picture corrective risk. You're absolutely right by saying that it looks very similar. It looks very similar to the S&P 500, and it does, just because just by market cap, S&P 500 is one of the biggest around the world, and not just S&P, but the US ones, Nasdaq, Dow Jones, and then obviously if they're going up, kind of the global economy is going up. But the global economy can also sometimes be a precursor for us to see, usually the global economy rolls over before your stronger markets are then going to tip into a recession, because it's going to hit the weaker markets, it's going to hit the global economy first, other markets around the world, and then at some point you have US maybe lagging, and it's going to hit them later on down the road. So it is important for us to also have an eye on other markets, and also sometimes every now and again, not every month, but whenever we see a candle like that, also observe what's happening here.